The firm Jollibee Foods Corporation, or the JFC, is a Philippine-based company that was incorporated in 1978. It was originally proposed by its chairman, Tony Tan Kak Tiong. It's an ice cream parlor in 1975. It was incorporated on January 11, 1978, and is now one of Asia's top quick service restaurant chains by market value, and is engaged in the development, operation, and franchising of quick service restaurants under the trade name Jollibee. The firm has expanded its operations by acquiring other quick service restaurants and extended its business to People's Republic of China, UAE, Hong Kong, Brunei, Saudi Arabia, Singapore, Kuwait, Qatar, Canada, and Vietnam. Jollibee Foods also engages in manufacturing and property leasing in support of the quick service restaurant system.
So now let us proceed to the financial statement analysis. Financial statement analysis is a crucial part of a business activities. Therefore, it is important to provide accurate and extensive financial statement analysis since it can directly affect firms and investors' economic decision. So there are various tools and techniques used in giving financial statement analysis. So one of those is calculating financial ratios. So financial ratios include liquidity ratio, debt management ratio, asset management ratio, profitability ratio, and market value ratio. So in this video, we will focus on giving analysis in the market value ratio. But before that, let us identify what is market value ratio. So market value ratio is a financial metric used in evaluating stocks of a publicly traded companies. So it is also used to identify whether the stock price is overvalued, undervalued, or at par in the market.
Earnings per share ratio. Earnings per share, also called the bottom line or net income per share, is a market value ratio that shows a company's profit divided by its outstanding shares from common stock. It calculates each stock's profit or loss per share for the current period. Earnings per share shows value in how profitable a company is. The earnings per share of Jollibee Food Corporation from 2015 to 2019 is 4.62, 5.75, 6.58, 7.66, and 5.8, while the average earnings per share for the last 5 years is 6.082, which isn't far above the 2019 earnings per share, which is 5.8, as well as the previous years. The earnings per share of JFC is above the industry average, which means that it has higher EPS or earnings per share than most of the players within its industry. It was also seen that the common shares outstanding has a forward increase for the last 5 years, while the net income decreased slightly in 2019. This may explain the small drop of earnings per share for the year of 2019.
The price to earnings ratio is a financial metric used to measure the amount of earnings a single share could produce for the company or the investors. Now, to compute for it, we just need to divide the market value per share over the earnings per share. Now, over the past 5 years, Jollibee has been experiencing some sort of volatility. Now, this could mainly be attributed to the fact that Jollibee has been on aggressive acquisition. Now, they have been acquiring companies such as the Coffee Bean and Tea Leaf and Smash Burgers in an attempt to gain international foothold. Now, their acquisition may have dented their profitability because the businesses that they have acquired were already loss incurring. So because of that, Jollibee has been compensating a lot lately. So we could see on the graph at around 2015, the price to earnings ratio started to plummet. It has created a downward trend. So at around 2016, that is the time wherein Smash Burgers was fully acquired, not fully acquired, but majority stake has been fully acquired by Jollibee. So through the process, Jollibee has cannibalized some of their earnings. Now, as we could see on the following years, there would be a gradual decrease of price to earnings ratio as Jollibee would try to compensate with the loss of the business that they have acquired.
Next will be the price to book ratio. And I am Mitzi Clark Kagmat, and I will explain to you the PB ratio. If you are an investor, what you are trying to achieve here is you should look for a way to decide whether a share is cheap or expensive, comparing the current market per share price or the amount we prepare to pay the share in the market to the book value or the firm's assets in order to work out whether the share is good value or overpriced. How are we going to know whether it is good or bad? There is a rule of thumb that says when the price to book ratio is above 1, then you are paying a lot for shares, and that is because that current market price per share is greater than its book value. But if the price to book ratio is less than 1, for example, the competitor has a 0.8 price to book ratio, then it suggests that you are getting a bit of a bargain by buying the shares, or in other words, you are potentially buying the assets of the company by paying for its shares for less than they are worth. So, when your price to book ratio is less than 1, that's a good start. But when it is more than 1, you need to be a little bit careful for paying too much for shares. Note that assets are the key driver for investors. In other words, the company assets are what you will base the decision to buy the shares on, not its earnings or its cash flows or its dividends. Those use other ratios. Therefore, price to book ratio or the PB ratio measures the market's valuation of a company relative to its book value. The PB ratio is used by value investors to identify potential investments and is considered as valid investment. A higher ratio also suggests that the investors are more optimistic about the market value of the firm's assets and its intangible assets, as well as the manager's abilities.
You can use the formula book value over outstanding shares to get the book value per share of Jollibee Food Corporation. The data can be found from the company's valuation. In 2015, the book value of Jollibee is 30,623, while the outstanding shares is 1,069.67. If you divide it together, you'll get a book value of 28.63. In 2016, the book value of Jollibee is 33,602, divided with 1,075.603 to get a book value of 31.26. In 2017, the book value of Jollibee is 40,783 and the outstanding shares is 1,085.31. You'll get a book value per share of 37.58. In 2018, the book value of Jollibee is 48,364 and the outstanding shares is 1,088.04 to get a book value per share of 44.45. In 2019, the book value of Jollibee is 49,294.3 and the outstanding shares is 1,093 to get a book value per share of 45.1. The book value per share is the ratio of equity available to common shareholders divided by the number of outstanding shares. This figures the minimum value of company's equity and measures the book value of a firm on a per share basis. This is also indicates if the company is overvalued or undervalued. Analysis. The book value per share of Jollibee in 2015 is 28.63, From 2016 to 2019, it increased its book value per share every year, surpassing its previous book value per share. It means that Jollibee's book value per share stock should be perceived as more valuable and stock price should increase.
Jollibee Foods Corporation or JFC is a Filipino company that was founded by Tony Tan and his family. They have been providing joy to the Filipino community through the Chicken Joy, fries, and hamburgers. They have expanded their operations and providing joys overseas. The Filipino Foods Corporation must continue their excellent services and consistent with their styles if they want to be still the leading Filipino fast food chain. They also need to respond with the changing needs of their customers, and so their income will maintain and improve by years. In order for them to improve on those unfavorable variances, they should take into considerations of whatever changes will come as the years passes by. To keep their spot as being the best Filipino fast food chain locally and internationally, they should improve anything that they are lacking into. And with that, they will maintain being a profitable company and they can able to sustain and maintain their competitive advantages.
Over the course of time, Jollibee Foods Corporation have been known as one of the giants in the Philippine stock market, having billions as an annual net income, not to mention that they acquire additional funds through investors who are continuously investing to the company. However, looking a few years back, Jollibee Foods Corporation had an intriguing financial figure as to how the company performed. Using three essential market value ratios for this analysis, it can be concluded that although the figures shows a downward trend, JFC still maintained to be highly liquid since its net asset value per share has a high value considering the fact that over the course of 5 years, JFC managed to overcome their previous annual book value per share ratio. Also, JFC manages their assets well. As a matter of fact, values in PB ratio exceeds to 1, which indicates that investors are optimistic about the market value of the firm's assets, including its intangible assets and company's administration. In addition, JFC will be considered as a risky investment since its EPS ratio indicates a drop at the end of 2019 due to the reduction of net income and its recent acquisition of Coffee Bean and Tea Leaf and Smash Burger. Nonetheless, JFC is still worth the investment since its recent acquisition of big companies does not only focus on short-term investment returns but also for long-term investment returns.